Welcome to Strategic Trading Radio Live. I'm your host, Alex Weisenbach, and I am the 12-year-old stock, options, and ETF trader. Let me tell you, I love ETFs, especially options. All the products are great, but of course, as most of my viewers know, a specific focus on options trading. What is wrong with the lights in here? Anyway, today, again, we have no interviews. We probably won't have a while because all the young traders are in school. All the young traders are in school for the most part. Lots of people who I have on also live in California, so, it kind of works like that. So you're stuck with me. I live in the Eastern Time Zone, so I can do a live show at 4:30 p.m., So I hope you enjoy the segment, and if you want to send an email to Strategic Trading Radio, you can send an email to strategictradingradio@gmail.com. We'll respond as fast as we can. We may have not answered a few emails in the past couple of weeks. I'm pretty sure we did, but it would be odd. It would be actually really odd if we didn't, so I'm going to also have to check on that. So yes. Otherwise, we'll move into the markets. But before that, I want you guys, please, check out Tasty Trade. Tasty Trade is a options trading network. Well, not options, a financial network. They talk about trading and finance, and that's pretty much the main thing at Tasty Trade. I could say it's better than my show. If you like my show and you don't watch Tasty Trade, you should definitely check it out. The founder of Tasty Trade and co-host is Tom Sosnoff. He's the founder of Thinkorswim. He also does a lot of road shows and speaks a lot in different places, but he also is a really good trader. He was a prop trader for many years, and you should definitely check out what he has to say. So after that, we got all the Tasty Trade stuff and all my stuff gone through. Send email strategictradingradio@gmail.com, or if you want to send me a specific question about trading, I can't give financial advice, but I can answer certain types of questions, constructing about trade management or certain things like that, but I cannot give you advice per se. So you could send me an email at alex.optionstrading@gmail.com, which is not just Strategic Trading Radio's email, but also an email for several other things I do, as in investment clubs. I do some investment clubs around the schools where I live. Of course, they're not open to just anybody. They're mostly just for the schools around. However, that should do it. So we will quickly just move into the markets. So let me adjust my charts. And by the way, before we do that, go into the charts and all the more specific things. S&P is down 7 points at 1654.50. NASDAQ up 2 1/4, down 57 points. The Russell down 10 cents, which is kind of weird. We'll talk about that later. Bonds up 12. You have notes up 12 also. You have the euro down a little bit. You have yen up. You have natural gas up. You have oil down just about 20 cents. Gold up 8.50. Silver up 57 cents, which is interesting. VIX up $1 at 14.99. So we're about to test the highs once again. Sorry about that. But we are testing the highs once again in the VIX. Then we have silver up 56 cents, and the VIX futures are at new highs, again at highs 15.84, up 64 cents today. Then the dollar, not really relevant to what I'm going to talk about today, so we won't talk about the dollar. However, I don't like wearing these headsets on the show, so I'm moving the headset around to fit my preferences and make you guys happy, because it doesn't look good to have some giant headset. So you'll have this on, you'll see that. Don't worry about it. It's just me talking. That is my mic for now. So let's go into the charts. Okay then. Well, I love this. I love this more. I reduced a lot of my short risk coming into this big up move and drop. So I started adding short risk on yesterday and today. So again, when the market goes down, you start taking money off the table. But this is I really like this as kind of a sell-off pattern. Now, I don't believe in patterns. I'm a tape reader, but this is bearish. Ooh, yes, I like it. Like for example, look at this. You know, you kind of get this, and you get this, and kind of weakness, and then. Yes, I know I'm a little nuts, but don't blame me. I'm 12. Just to let you guys know, if you didn't know, yes, I am 12. I am a 12-year-old trader and investor per se. So, I may act a little like a 12-year-old on the show. I hope you guys don't mind. I am a little 12-ish. Computer problems. Anyway, let's see if I can get everything working. Just to prove to you, I am 12. See? Anyway. Okay. So I like this as a sell-off area. This is an interesting area to short. I added some short risk on. I added actually quite a bit. I put in a VXX covered stock position. I'm closing quite a few longs actually. I sold a put spread in the bond market, making me inherently short the market. Then I have, oh my god, I only have a few long positions on. However, I do have a few again. So let's get this straight. I am short Yahoo. I am short WLT. I'm long VIX per se. I am short a little VIX through an iron condor spread. And I'm looking at a computer screen right here that you can't see, but I have short oil, short bonds, which is short stock, long bonds, which is short stock, short SLW, short NASDAQ, short Newmount, short JP Morgan. Then I'm long a few things. Then I'm short gold, short yen, short or long yen, but inherently short the market through that. Short Germany, short emerging markets, short FXI, which FXI is actually an interesting trade. I'll show it to you. But I did FXI's stock, so I sold 50 shares of stock in FXI. Okay, so I have about 20 positions on, and then I'm short. Okay, and then all those are long. So I'm long some individuals, like very small, like Broadcom. I'm long Banco Broadchesco. I have no idea what that is. I have Delta Airlines. I have little long Dow Industrials. I'm a little bit long Home Depot, but that will be a closing position pretty soon. I'm long Hewlett Packard, JCPenney long, and then I am long SPY as a hedge, and then a few other things. But today was actually some decent profits. So for me in my accounts, I was actually rather happy because the markets were down. But again, I took off less of short risk, so I'm managing my accounts as we go. Very hard year though it's a really hard year for premium sellers because of low VIX. So since we're getting into this, first of all, you never ever fade the VIX, and it's taking a minute for it to load. You don't fade the VIX until we get way overextended and you like the stock market, but you don't sell VIX just because you sell, because VIX will pop hard and fast. You never sell VIX directly when it is obviously going up. So, we have gotten to close to mid-range levels. Close to mid-range. Not mid-range, not quite mid-range, but close. So that means we still have room to go up because the VIX is the most reverting to the mean product around. what's the range? 22, 12. So that's a 12-point range. So 12, 18 should be right here is about the mean. Okay. So, we always revert to the mean. If we get above average, you can start selling if, the S&Ps look attractive to you. However, like selling puts and stuff, like not getting short vol, short stock doesn't make sense. However, you don't fade the VIX until we're at mid-range, which we are not. We are not in mid-range. To prove it to you, I'm going to go check SPX, S&P 500, and this is just a fake position I have on, guys. I really need to get rid of the paper account and clear up all the positions. And I was just playing around with these very weird SPX positions, selling junk and all kinds of stuff, doesn't matter. But looking in here, I want to show you something. I want to show you if we can get it, today's option statistics. IV percentile is 30th percentile. What this means is that between a range of 0 and 100, we're 30% in the implied volatility of the SPX. Now what VIX is, it's pretty much an exact measure of S&P implied volatility. So in other words, don't be fading the volatility yet. And it's taking a minute to load. There we go. Don't be fading the volatility yet. I'm still getting long. I have a covered stock position in VXX. Now, lots of people say, never cap your upside. Never do it. It will ruin you. It's worthless. It's terrible. Never, ever, ever, ever cap your upside. Well, I'm going to tell you something. Cap your upside. You know why? If you cap your upside, you have a high probability of success. Unlimited risk, low reward means high probability of success unless you're doing stock. Like, for example, just stock. For example, if you do something like, I'm going to lose 3 to make 1 stop loss. You have a 50% probability of success, but the probability of your stop being touched is much, much lower. So you have a higher probability, or it's still 50-50, but you have more risk to the downside, less upside, but you can be in your position much, much longer than if you were stopped out. So for example, if markets go down, you're still bullish, for example, you can measure the probabilities. So I'm actually going to switch over to show you how you can do it. There's a feature in the Analyze tab, and it's taking a second to load, but there's a feature in the Analyze tab, alright? I'm looking at the S&P 500 probability. So this is a standard distribution curve. For people who argue that standard deviations and distribution curves don't matter, it's not true. Forget that. The markets by expiration are within their standard distribution, but when we're with a stop, for example, I'm going to explain the following stops. The smaller you move your stop, the closer or the higher the probability is for you to get hit. And if you keep really close stops, your probability of getting hit will be almost 100% from a 30-day basis. If you say lose 10 cents to make 30 cents on a $30 stock with 60% implied volatility, okay, well, think about it. You're going to get a certain expected move, so you take the stock price times, there's a formula to do it, but for example, I'll show you examples later. However, I'll show you the probability of touch. So we are going to go to a 1-day time frame. Today is 8/27, so we're looking 2 days out, right? So let's say you have S&P 500 stop at 1656. Alright, so 1657, you're short the market, and that's where your stop is. It's a 3-point stop, which is small. you have it was almost a 90% chance of success, and you can barely see it. All right. If you want to widen your probability range of a 95 percentile, which is the 2 standard deviation move, it's same thing, but with the 2 standard deviation move, which is there's a 95% chance that the S&P will not be at 2,000 by a certain period of time. What? This is January. All right. So say you're looking at a 10-day time frame. All right. So say we are. We have so the S&Ps are trading at 1654. So we have 20 point stop in, right? To make a 20 point make 60, so 1720 is where we want the S&Ps to go. If there's a stop here, there's a 55% chance you're going to be tested, and there is in 10 days, 55% chance. And there is a 16% chance we will even get to your target. That proves the stop and target method work over time, and these numbers I'm showing on the screen, these numbers are proven. These numbers are proven to work. Now, most people, they put stops in, they put targets in, they trade by their rule book, but 90% of people, individual investors who trade, lose money. Look, the most successful traders I've seen, they may use a stop. They might because it's just the way they like to trade. They feel more comfortable. They usually don't set targets. And the very best ones, the greatest traders I've seen, all below 20 by the way, never ever use stops. The way they control their positions is sizing and volatility of their portfolios. They don't use stops. Because price action may not just invalidate it. They trade in and out of the positions, they may generate more commissions, but it's more profitable than using stops. That is the main issue with stops. Okay, so I had my daily rant. We talked about the markets a little bit. Just a few things I want to show you guys. Just a few things. Okay. My few things here is gold. Keep this short and sweet. I have things to do at like homework. Gold, I really like gold short because it's a very interesting short going into the market. It's kind of a hedge against other positions because gold can be a little bit of a fear play. Fear's gone up in the past few weeks, so then it makes sense for gold to go up. Economically, there's less demand for gold because of the high movement up, and I can show that to you. We're all the way up here in the $2,000 level, 1923. People thought it was going to go to 2,000, not so much. Anyway, kind of looks like an interesting area to short as a hedge against the portfolio. You know, I have a lot of gold shorts on because they're very interesting to me, and oil is also very interesting short because oil's kind of short stock. We've been trading this range for a little while, but if we can break out of this range, now I'm still short and I'm up a little bit on the position or flat. But if we can break through this range, it probably means the S&Ps can start crashing and burning also, because that's often what happens. Alright then, guys, we're going to go on a short break. I hope you enjoyed this segment. Next segment, we're going to go through a DIA short put spread I put on, IWM long call spread, short put spread, and HPQ, a short call spread, and EEM, and a Yahoo bearish diagonal spread. And possibly another VIX trade if I seek discretion. And we may talk about VIX depending on my time. So I hope you enjoyed this segment, and we will be back in a minute. Welcome back to Strategic Trading Radio Live. I'm your host, Alex Weisenbach, and I'm a 12-year-old stock and options trader, mostly options, but you know. So this is the segment. We already have my ranting segment, which sometimes doesn't get recorded. Sometimes my rants don't always get recorded. So this is the segment where we actually go through some trades I've done or am looking at. I already told you guys about my FXI short. I shorted 50 shares, kept it small. You know, I'm a small trader. I'm a little bit of a baby. No. I just believe in the theory of trade small, trade often. If you take on lots of little bets with a high probability of success in the options market, the closer you get to 70, you get a higher probability of success and you can manage those trades. It's much different than gambling, because in gambling, only you can't manage unless it's a game like poker or blackjack, but you can't manage your odds. It will end up being a zero-sum game. It's not a zero-sum game in the markets, necessarily. If you make money, somebody lost. Not true. There's a million things. There's different margin, there's different commissions, there's different arbitrage opportunities. Who knows what they are? But markets aren't exactly a zero-sum game. If 90% of individual investors lose and 10% of individual investors make, competing against each other, including not factoring institutions, there's no way it can be a zero-sum game. So just letting you guys know that was my short rant. So let's get into some trades. Okay, guys. I don't know why a chart is up there. It's taking a minute for everything to load, but I never, ever look at charts in this segment because it doesn't matter. We're trying to focus on what's in the options chain. So just assume that I think that because the market's overextended. Assume what you want. That's my opinion. So if you like the trade based off my general logic, then do the trade with me. Alright, so I don't really like this trade, but I need to sell it. I want the put spread. It's 40% implied volatility, so it's decent. 40th percentile, so it's decent implied volatility. So I believe if I check my real trade, in here, because I have so many positions on, I have September. Okay, September's fine. So I sold a put spread in September, and there's probably some reason why. Yes. Okay, so I sold this. Sell vertical, deep and wide, sell, deep and wide, vertical spread, 1 month, 2 strikes. Sell, deep and wide. 1 month, 2 strike, vertical spread, boom. Okay, then. We have a 69-cent credit. Ignore the expected move. It's just the weird pricing after hours. No big deal. So you get 69-cent credit. High probability of success. Probability of success around 65%. Well, actually, it's like 60.5%, but don't worry about that. Your break even is 48.31, so the stock has to fall 90 cents before you start losing money by the time of expiration, if you plan to hold that long. So it's a decent trade that I like. Personally, that's what I like. It's just selling a put spread. If that's not enough volatility for you, just buy a call spread. Buy vertical or buy deep and wide 2 month 1 month 2 strike vertical spread, 102 debit, 51% probability of success. Max profits $98, max loss 102. That would be debit spread you could do instead of a credit spread. So that is kind of your choices in DIA. Next thing is IWM. IWM is the Russell Index, and I think I am talking too fast. Okay. So IWM 45th percentile. I bought the September. I have a September call spread on that I like. I buy vertical, September, and I'm moving the strikeout to 2 strikes in the money, 117 debit, which is cheaper than I bought it. I'm losing just a little bit on the trade. $83. Probability of success is around. Yeah, that should be 58-ish, 58.5% probability of success. If you see the stock has to fall 1 cent for you to lose money, so right here technically, but you can still do some stuff with it. So that is a trade I did in IWM, and I'm going really fast, I know. Okay, so that there's not a whole, there is a logic chain, but sometimes you can just tell implied volatility is here, this is what you need to do. It's very quantitative. It's not very qualitative. Now you can quantify the implied volatility and kind of base what trade makes more sense based off implied volatility. What you have to qualify is what your direction is and how you figure out that trade. So then you have emerging markets. Emerging markets are around the 49th, 48th, 46th, and 45th percentile implied volatility. Let's check. 49. Okay, good. Okay, so you know what I'm going to do? Ooh, boom, sell, vertical, deep and wide, 1 month, 2 strike vertical spread, 39-cent credit with a bearish edge, which I need to widen to 40.5, 59-cent credit, max loss of 141, probability of success wrapped around 70.5%. I like that trade. High enough implied volatility, some interesting movement. However, you may not, that trade might not be good for you. You might want to sell volatility in this. You really can't do Iron Condor. You could do a volatility expansion play also. For me, it's from the bearish side, but what you could do is you could buy a directional diagonal. You can route this as one order, so what you do is, you do buy diagonal, and then you have this September, what is going on here? Oh yes. My diagonal. And then I'm not doing the weekly option, I'm going out to October. I am not gonna be doing that for credit, so whatever strike is in the money is 39.5 is going to be my long. Yeah, 39, I'm buying the diagonal. 39.5 is my long, 39 is my short, 58-cent debit, that's your max loss. And then basically what you want to do is you want volatility to expand. You want volatility to expand, you want the price to go down. It makes perfect sense based off the directional bias you have, and it should be a pretty decent trade if that's what you want to do, and that's basically the logic for that. Okay, so next and last trade that I'm going to look at today, I did 7 trades today in total, but I'm sharing them on My Trade, so if you look up Alex, a 12-year-old on My Trade, you can find me there. Okay, so I'm not very... So what you do is you go to the put spread side, you buy a diagonal spread, yeah, and then you have the Octobers. You should be buying the 28s because you buy the in the money because that's what makes it bearish. And then I'm going to sell the 27s, a $1 1 cent debit. I'll kind of show you what it looks like here. Analyze duplicate trade, and then we're still in here, and it looks generally looks like this. The thing is, there's some sort of fake position in here that's missing, so I'm deleting that. This is what it looks like. It's still relative, but when you start getting, you lose money. So you want the stock to go down, basically. You want it not to go down farther than 24. You want a little bit of vol expansion, quick vol pop, and start making money around expiration time. So that's when you have to pay attention to these spreads, and you have to be careful with them because it's kind of a time spread, which makes it very expiration focused. Alright then, I hope you enjoyed this segment. Thank you for listening. My name is Alex Weisenbach. I'm a 12-year-old stock and options trader. If you have a question, send an email to strategictradingradio@gmail.com or something to me at alex.optionstrading@gmail.com. I hope you enjoy the show. Thank you for listening, and that should be it. Thank you.